We're thrilled to have you with us today. And as others are joining us, we'd like to request that you go to the chat at the bottom of your screen and enter your name and where you're at, your location, so that we can get a sense of who is with us today. So again, welcome. As you're joining us, go to the chat, give us your name and location, and we'll get started as soon as we have a few more people with us. My name is Doug Dixon. I'm board chair of Encore Boston Network, and I'd like to welcome you to our webinar today on financial planning. See, a few people have entered their name. I see Tom from Winchester and Kendra from North Kingston, Rhode Island. If you haven't given us your name and location, please do so. We welcome you to today's event. We want to get started. Others will join us, I'm sure. So today's, I'm sorry, is there a question? If you could mute yourself, that would be really helpful so that others of us won't hear your private conversation. Again, my name is Doug Dixon. I'm a board chair of Encore Boston Network. Welcome to today's program on financial planning. There are a couple of things I want to mention before we get started, and that is please mute yourself so that we can all hear the speakers. Also, we are recording today's event, and that's to allow all of us a chance to review this material later. We'll send you a copy of the recording in a follow-up email along with resources that you'll hear about during the program today. And we'll also post it on our website so that, again, it's available as a resource. So today's topic is financial planning, and we hear a lot of questions about this topic because it can seem very complicated. And what we're going to try to do is to simplify some of the information around the financial planning today. There are questions about whether this is something that I can do myself. Do I have to hire someone to help me do it? If so, how do I find someone that I can work well with and trust? And we're going to cover all of those topics today and more. With us today to walk us through this kind of complicated territory is Glenn Frank. Glenn is Director of Education at Lexington Wealth Management. He has been identified. He was the founding director of the Masters in Financial Planning program at Bentley University. He has been a Financial Planner of the Year, and also he's the author of a book on retirement planning called Your Encore, How to Balance Time, Money, and Joy. So welcome, Glenn. We're glad to have you with us today as our sort of expert on this topic. And here to interview Glenn is Steve Lewis. Steve is a retired chief financial officer. For many companies, he has, since his retirement, been working in several capacities, including running a few programs on financial planning for Encore Boston Network, of which this is another. And he also works in a program that helps to provide information on Medicare called Shine, and to assist people low-income taxpayers with their tax returns. So Steve is very busy doing good things in his retirement, including working with Encore Boston Network. So at this point, I'm going to turn it over to you, Steve, and help us learn a little bit more about financial planning.
Okay, super. Thanks so much, Doug. And really welcome everyone. It's just great to have you join us. I'm really excited to be with you and with Glenn. Glenn and I have collaborated on some other financial types of topics for Encore Boston Network. And Doug described some of Glenn's background. He has a wealth of financial planning experience. He explains things in a very clear and informal way. And so it's just great to be with Glenn today. And so I'll be interviewing Glenn on a number of aspects of financial planning. And so as you have questions, please enter it into the chat function and we'll do our best to respond to those questions. And the other thing just to mention before we get into the questions is that the focus today will be on the financial planning process. I know there's a huge amount of uncertainty in the financial markets that might really increase people's anxiety. But today we won't be focusing on specific investment strategies. So then we'll just start off. One of the decisions is, do I do financial planning on my own or do I engage a financial advisor? So what are some of the considerations that someone should think about in making that, it's an important decision. What are some of the considerations?
Thanks, Steve. Good morning, everyone. I love Encore Boston Network. It's a marvelous community. I hope you join it if you're not already a member. As far as Steve's reference to stress and anxiety, I like to start every class and every day the same way, and maybe you want to do this right now and indulge me. Maybe a nice open stance, some deep breathing. If you do this, it's been scientifically proven that in 3 minutes, your stress levels will go down by 30%. So again, indulge me for a second here, nice open stance, deep breathing. As far as Steve's questions go, what are some considerations? Huge word is trust. Do you trust yourself? If your partner is making the financial decisions, do you trust them? And could or should you trust a financial advisor? Realize that the relationship, all of them really need to be about win-win. So you need to understand the definition of win for the client, yourself, as well as the advisor. You need to understand their business model. That's a big issue. Another consideration is it's all about alignment of interest. You need to find somebody that is a match for you. You have needs, they have services. Will 1 + 1 = 3 or not? Another consideration, Doug referenced, I've got this book, and I really do think that all major decisions and even minor decisions are about this juggling act between time, money, and happiness. So is this one. Regarding time, will you find the time to do this stuff yourself or not? Are you a procrastinator? Do you need a motivator? Time's a big issue here. Money. Is an advisor a good investment or not? On a net basis, after their expenses, will you do better with an advisor or not? So financially, it matters. Maybe you need an emotional buffer to get you through these difficult times and that we're experiencing this year. As far as happiness goes, I really strongly believe that if you do a financial plan, you're going to be happier. It's pretty unsettling not knowing where you're going. So it's very important to do a financial plan. Whether you have the capabilities and interests to do it yourself, I'm not sure. Hopefully that'll reduce stress levels in addition to this open stance. And then finally, there needs to be a certain level of complexity before it warrants hiring an advisor. So whether you have enough complexity to make it worthwhile, I'm not sure. But those are just some broad considerations.
No, thank you, Glenn. And just one thing you mentioned, I just want to probe a little bit more is, if someone doesn't have much money to invest, is there still value in doing a financial plan?
Well, tremendous. Everyone needs to know where they're going here. You need to do some future cash flow projections. And if you don't get your arms around that, you're going to be very unsettled. And the worst thing in the world is outliving your money, perhaps. We don't want that to happen. So even if you don't have a lot of assets or any at all, how long should you work, doing what, full-time, part-time, start a business, inflows, outflows. One of the things I bring up on my book, and I don't mean to plug it too often, is this concept of happiness per dollar. I'll bet everyone in the audience, if you went through all your expenditures and really were very thoughtful and very self-aware about where your money's going, I bet that you could probably realign things and spend less money and actually be happier. I know that sounds like pie in the sky, but I mean, if you think about it, probably things that put a smile on your face every day, the vast majority are probably very low cost or no cost. I don't want to digress too much, but absolutely, regardless of your level of wealth or lack thereof, it's very important to do a financial plan of some sort.
Thank you. And if you decide to hire an advisor, what are some of the important things to look for in choosing an advisor?
Yeah, so again, it's all about trust. And I've always used these 3 C's: concern, calm, and conviction. You have to find an advisor that's genuinely concerned about you, which isn't very easy to discern sometimes. And by God, one of the biggest value adds an advisor is calmness. You don't want people to make emotional decisions. And they better have conviction in what they're doing. If they don't have conviction, you won't have conviction in them. So that's a big thing. Some other things to look for, obviously experience and credentials. This is a subtlety. I think it's a good idea to find someone who's an educator as opposed to a marketeer. If you're going to talk to an advisor, have them tell you about them first. Then you'll see who they are. Sometimes advisors can be kind of chameleons. They figure out what you're looking for, and then that's who they become. So I think it's important to kind of somehow independently gauge who they really are and what they really do. And I think it's very important that you find them as opposed to them finding you. So there's some subtleties, and we'll talk about conflicts of interest. We'll talk about how people get paid, but you need to understand these things to make a really good informed decision.
No, thank you. And something you just touched upon was how do different financial advisors, what is their structure and how they get paid? So what are some of the different types of financial advisors, and how do they get paid? And I know you'll get into, how does that influence the relationship and what works for each person?
Absolutely. So we actually we have a couple of slides. I've kind of done this topic, council of aging groups that are particularly vulnerable, community education. So I've covered this topic many times. I got a ton of slides. There's just a couple I'll bore you with today. So there's 2 slides that are particularly on point to answer that question, Steve. If Kendra could be so kind. So Kendra, maybe it was slide, I don't know, 4. Thank you. So these are my categorizations. So I kind of break relationships up into 4 categories. We have brokers who buy and sell things. They get paid on a commission basis. They might be particularly appropriate if you like to speculate and you like to have a colleague in your speculation. I can't help you there. If you want to do that, good luck, God bless, and anyway. A money manager is someone who's probably focusing on one particular asset class. They invest in large tech companies or whatever, something like a mutual fund. So the first 2 may not do any planning for you. I don't know. Then there's an actual financial planner. That's somebody who should be able to get their arms around your entire financial situation, pull it all together, and help you make informed decisions. Hopefully they're very holistic. There's also this category called wealth manager. And the wealth manager wears 2 hats. a good one. Number one is they're a financial planner. They understand your whole financial situation. They understand where you are today, point A, and where you're trying to get to, point B. They also handle the ongoing issue you might have if you have a portfolio. They may be effectively your chief investment officer, hopefully somebody you can really trust who will manage your investments to kind of get you from point A to point B. So those are the 4 general categories. My guess is if you want true independent objective planning, you're probably going to need one of the last 2 categories. So those are the generalities and it's not necessarily easy. It's not like you're going to go on a website and they're going to label themselves one way or the other. You have to sift through it, and they may all talk about financial planning. Whether they all actually do it, I'm not sure. Hopefully that helps. Now, as far as how people get paid, if I look at the next slide, it'll kind of give you a visual. There we go. And again, as I mentioned earlier, it's very important to understand their business model, and they're all businesses. You know, some more so than others. You know, Steve, you earlier asked kind of what you're looking for in an advisor. Ideally, you find somebody who it's more of an avocation for them. Gee, I'm such a lucky person. I get paid to help people. You gotta love that attitude. So not everyone has that attitude, and some are more on the business bottom line profit end. In terms of how people get paid, I kind of break it down into commissions or not. So we have people that aren't commission basis, traditional brokers, and it's very transactional. They get paid if you buy something, you sell something. Obviously, they have greater conflicts of interest. They don't get paid unless they get you to do something. And then we have on the other end of the spectrum, we have people that are, quote, fee only, which is not fee based. A lot of confusion out there. Fee only is they only get fees, they never get commissions. Now, their fees might be a function of getting paid on an hourly basis. Maybe you pay them a set retainer. Probably the most popular way that fee only planners like to get paid is a percentage of assets. You know, somehow you saved up $1 million, they might charge you 1% a year, $10,000 a year. So that's fee only. And I believe that's a better alignment of interest. Basically, you're going to pay them that $10,000 to serve you during the year. And if they don't serve you well, you let them go. There's this term in this industry called fiduciary. If somebody is a fiduciary, they're supposed to do things that are in your best interest as opposed to theirs. Fee-only advisor is more likely to be a fiduciary, if you will. Now, that's not to say that fee-only advisors don't have conflicts of interest either. They do. It's not to say that fee-only advisors are the only Eagle Scouts in our industry and the commission people are not. That's not necessarily the case, but it's just perhaps more often the case. Hopefully that helps.
Yeah, thank you, Glenn. And as you're looking at this, it's a really interesting slide, the interesting chart. You know, my question is, if someone decides to invest money on their own, but they want to engage a financial advisor just to do a financial plan, and perhaps for a specific fee, is that an option?
Yeah, that's a difficult option, and that's something that's very, you know, is ideal for a lot of people. As I mentioned, the assets under management approach is most popular for fee-only advisors because it's basically, if you're starting a widgets factory, it costs you a heck of a lot of money to get that first widget out the door. But then the more and more widgets you sell, the more and more bottom line profit. It's much more leverageable. You know, once you put together investment portfolio strategies for one client, it's so much easier for the second. So the best business model for most fee-only advisors is assets under management. Now, but if that doesn't fit you, if you don't make their minimums, or you want to do it yourself and save their fee, can you find a financial advisor that you can trust who doesn't require assets under management? Again, I believe that the most trustworthy are likely to be fee-only. And there's a couple of fee-only organizations that come to mind. NAPFA, the National Association of Personal Financial Advisors. If you're not writing this all down, it's okay. We're going to send you stuff later. But the thing is, with the NAPFA folks, they're probably looking to manage your money. And the ones who aren't, that are just purely hourly or whatever, they're probably, their plate is probably full. There is an organization that doesn't necessarily request or require the assets under management, and that organization is the XY Planning Network. So you can go on these websites and you can find an advisor, pop in your area code or whatever. You can probably find somebody that way. Or you do it yourself. Do the financial planning and investing yourself. And we'll get into ways to do that later. But yeah, it's difficult to find a very trustworthy financial planner who doesn't want to manage your money.
Thank you. And just going back, if someone wants to do the financial planning on their own, are there tools or resources that they can, on the internet, et cetera, that will be helpful to them?
Yeah, certainly. Now, always a caveat. Stuff appears to be free, but it's not. So there's some marvelous resources out there, but there's probably a follow-up sales pitch of some sort. So Personal Capital, tremendous number of great resources on their website, but there'll be a follow-up. They want to manage your assets too. You can just say no, that's fine. Another organization, Smart Asset, tremendous resources there. They're also going to try to hook you up with an advisor and get paid that way. One organization, they're pretty much all for profit. The one who's not for profit is Vanguard. Vanguard is basically owned by the investors. It's a mutual that owns mutual funds. So Vanguard is a very trustworthy resource. You can go, I'm going to give you some links to websites where you can find some, best financial planning software kind of thing. You can go to ARP, they'll have some calculators, etc. Again, a lot of these places, you can find a lot of these resources. But again, if it's, is it truly free or not? And understand the implications of that. But yeah, there's lots of great resources out there.
Okay.
In fact, I'll give you the name of a book that might be very helpful on the investment front. So isn't in life usually the more time you spend, the better you do in most endeavors? I don't think that's the case with investing. I think often if you're watching these markets every day, you're probably going to do yourself a disservice, drive yourself crazy, and cost yourself money. So investing is, I'm not saying ignore what's going on in the world. What I am suggesting is you come up with a portfolio that kind of matches you and your circumstances. And again, don't look at it every day. A marvelous, if you want to read a simple book in like 2 hours, and probably do better than 75% of the investors out there. There's a book by this guy, Goldie, called The Investment Answer. And if you take, but the book is dated. So the allocations they're using, how much in US and international, are kind of dated. Here's a combination. Read that book. Then go to the trustworthy resource, Vanguard, and see what their forecasts are, their long-term forecast for US stocks, US bonds, international, et cetera, et cetera. So I'll bet if you take those two resources, read that book, go to the Vanguard forecast, I think you'll do better than most with not a lot of time.
Very good, thank you. And one thing I just want to briefly emphasize, one of the things that'll be sent to everyone after the interview is Glenn's put together about 20 slides that just has a wealth of information of links, resources, et cetera, that really should be helpful. And so, just getting back, Glenn, to one of the things you mentioned about, when you're looking at for a financial advisor, the whole issue of trust and just the idea of, what pitfalls, there's no guarantee, but what pitfalls to try to be cautious about to try to avoid. What are some of the conflicts of interest or other considerations one should look for? Perhaps, what kind of questions one asks when one's, I'll say, interviewing financial advisors, to consider working with them.
Yeah, a great key question, Steve. Thank you. A couple of comments on conflicts of interest. All advisors have them. And I think that's fine as long as they're laid out on the table so you can see them. And again, just because they have the conflicts of interest doesn't mean they won't rise above them. So we've got some obvious conflicts of interest and we have some subtle ones. Obvious conflicts of interest, commissions, if they get you to buy and sell stuff, insurance, whatever, that's how they get paid. Tremendous conflict of interest. If they're fee only, again, and they're charging you 1% of assets under management, and you got that, you saved up that $1 million, and you ask the advisor, should I pay off my $200,000 mortgage? Well, there's a conflict of interest. Their fee will go from $10,000 down to $8,000. That's not to say they won't tell you to pay off the mortgage, but it's a conflict of interest. Or if they're on an hourly basis, you go to XY and they're charging you hourly, will they drive up more time than is necessary? Or maybe they're too busy and they spend less time. Again, conflicts of interest, again, they can be risen above. Those are the obvious ones. There are some subtle ones, some insidious ones. You talk to your financial advisor and you say, gee, I need a new CPA, I need an attorney, I need some other advisor. Will they send you to the one who's very best for you or the one very best for them? Somebody who refers business back. Maybe that's fairly obvious too. Again, that's not to say they won't send you to a good person. It'll reflect poorly on them if they don't do a good job for you. Some other subtleties. Taxes. I don't know what people hate more, understanding taxes or paying them. And it takes a lot of mental energy on the part of the advisor. And it's typically stuff that the clients don't get or didn't ask for anyway. So that's kind of a conflict of interest of how deep will they go on to the tax side. I will say this, if your situation is complicated enough on the tax side, a really good advisor may be able to cover their entire cost by being smart with taxes. Here's a major conflict of interest that's pervasive across the entire country, fee only, commission, whatever. And that is, people are kind of slaves to a benchmark. So we have, today, it's an acute issue. Now, if you open up the Wall Street Journal today, the New York Times, the Boston Globe, the vast majority of articles and commentary is about one market, ours. They might give you different flavors, the Dow, NASDAQ, S&P, but it's all kind of the same market. So advisors know that each and every day you're tuned into that because you're being fed that continually. So the conflict of interest is for the advisor is to deviate from your expectations. There's an old Keynesian quote. It's better for reputation to fail conventionally than to succeed unconventionally. So there's significant business risk on the part of the advisor. If they deviate from your expectations, and they may ultimately be right, but in the short term, they could be wrong. And you're going to be disappointed and you're going to say, see you later. So what's interesting at this point in time is universally, every major institution has higher forecasted long-term returns off our shores than on. Yet their advisors have a larger allocation to US equities than they have to international. Now, that's just not me making this up. You can go again to Vanguard, you can go to almost any of these major institutions that are all going to have these higher forecasts for international than US. But again, this is a huge conflict of interest. And so investors have a home country bias. People like to invest in things they know. And the reason those forecasts are much higher internationally is because the last 10 years or since the crisis in 08, 09 is US has done a lot better. Well, mathematically, there's something called a reversion to the mean. And valuations get high, they come back down. And from an historical perspective, 80s international did a lot better. 90s US did a lot better. Up until the 08, 09 Lehman thing, international did a lot better. And since then, US has done a lot better. So there's a kind of back and forth thing. I'm kind of going on about that issue, but it's a big issue today.
No, thank you, Glenn. That's great. And I guess another question would be the next step in the process if you decide to hire on someone as a financial advisor. And this is a question about, navigating that relationship. Something I've listened in on other, interviews you've had, and you talk about a 5-step investment process of kind of what are some of the key things to discuss top level with a new financial advisor for you. Maybe you can just, share that with the group today.
Sure, Steve. So we got a slide for that. Kendra. So I've been on investment committees and I've been teaching for decades. And I created this 5-step investment process literally in another century. And all my colleagues and all the firms I've worked at, all my students are using this 5-step thing. And it's a time-tested, hopefully very methodical process. It starts with financial planning. How much return do you need to get from point A to point B in life? So when you do those cash flow projections, again, if hopefully you've been able to save up some money, you have to figure out what kind of return you need. Maybe you're very fortunate. Maybe you don't have to earn much at all. Maybe you can be very conservative with your portfolio. Then again, if you really need to beat inflation, et cetera, by a certain amount, you're going to need to be more aggressive. Or rethink your goals if that's not going to keep you up, if you're going to be kept up at night by being too aggressive. A couple of things, I've got this rule of thumb about rules of thumb. And my rule of thumb is don't have them. So for example, people use this, my age from 100 is how much should be in equities. And there's some merit to that. But if you're 60 and that says you're supposed to put 40% in equities, that can be a little dangerous. I don't know that it's appropriate at all. It might be too much, might be too little. It's got to be tied to your financial plan and the projections you're using. The other thing that's honestly annoying is this industry very often asks you a couple of questions to pigeonhole you as either being conservative, aggressive, or whatever. And that's an unfortunate shortcut. I mean, I've had 90-year-old clients who are 100% in equities. They're never going to run out of money. It's for their grandkids. I've had 50-year-old clients that have 0% in equities because they've got plenty. Their kids are already getting too much, and it's unfitting. So my point is, do your financial projections. In those projections, you're going to have an assumed rate of return. And how large does that need to be? That should drive how aggressive or how conservative your portfolio should be. Step number 2 is huge. Your portfolio performance will be driven by the asset classes you use. How much in US stocks, how much in international, how much in US bonds, how much in international, how much in growth, how much value. There's lots of other asset classes. That's what will drive your returns. There's some good news here. There is some free lunch. Free lunch is understanding the basics of correlations and valuations. Correlations, everyone says you're supposed to be diversified. Well, here's the concept, very simply put. You can have asset classes that are risky by themselves, but because they behave differently from each other. because they have different correlations to each other, that when one's zigging, the other is zagging. The net effect is you put those together and you're going to end up with less risk. And that's very important from a compounding perspective. Big loss years are compounding killers. Hopefully this will not continue to be one. So you need that smoother ride. So pay attention to things that behave differently from each other. The second piece is valuations. I made up this concept years ago, buy low, sell high. I'm kidding. That's been around forever. It sounds so simple, buy low, sell high. You can't buy low, sell high if you don't understand if things are high or low. You have to understand valuations. Are assets up on the roof? They on the first floor? Where are they? Well, there's an old quote. The stock markets are a voting machine in the short term, a weighing machine in the long term. I don't know how people are going to vote in the short term. I do have a strong expectation, and all these forecasts I'm talking about, including Vanguard, it's a weighing machine, and sooner or later, things that are overvalued will come down, sooner things that are undervalued will come up. So you need to have some sensitivity to valuations. Step number 3 is fairly unimportant, honestly. You have to capture those asset classes, but people spend a ton of time on step number 3, how to, so this is not an endorsement for US value stocks. This is just an example. So let's assume that you're going to put 20% of your portfolio in US value stocks. Again, not an endorsement. How are you going to actually do it? You're going to buy mutual funds, you're going to buy the individual stocks, or you're going to use exchange traded funds. You have to decide how to capture these asset classes. I'll give you a shortcut. If you read this book I'm suggesting, The Investment Answer, they're going to say just buy exchange traded funds. These are very low cost, very tax efficient. You can capture whatever asset class you want. And there's a real subtlety here. Remember I said this is all a juggling act between time, money, and joy? If you buy ETFs, the amount of time you spend should be a lot less. You don't have to manage, is this guy really not the next Warren Buffett? This guy really isn't the next Peter Lynch. You don't have to worry about that. Now, if you buy ETFs, you're waving a white flag about beating a market. You're not going to beat a market. You're just going to capture the market inexpensively. If that's okay with you, that you're not, quote unquote, winning and beating the market, then mathematically, you're likely to be in the upper echelons of investors. Again, without a lot of effort. So that's my strong recommendation is at least start with ETFs. Sometimes they're flawed, they don't always work, but in general, for most folks, that works. Step number 4, if you are fortunate enough to have saved some money in taxable accounts and some money in retirement accounts, you have to decide which investments go where. Just like real estate, it's location, location, location. So mathematically, that matters. If you're going to put 20% in value US stocks, you're going to hold that in your retirement account or your taxable account. I'm not going to go into that in this session. We have some great resources that address investment location in your materials. 5th and finally is, this stuff is circular. When something in the first 4 steps changes, so should your portfolio. Planning's changed. There's an inheritance, there's a big debt, lots of things are happening. Asset classes. Suppose you decided to go with US value. Suppose it does really well. Will you have the discipline to actually ease up on it? And something that you believe in long term has done poorly, will you have the discipline to buy more of it? You're supposed to. So other things might change as well. So this is not set it and forget it, but it's also don't look at it every day. again, that'll drive you nuts and it'll cost you money. So very short synopsis. Normally I torture my students, this classes that go on for 10 weeks, 3 hours a night. But that's probably 90% of what I suggest to my students.
Thank you so much, Glenn. And so Glenn's, given hopefully, a really good overview of various considerations about the financial planning process. And again, after the interview, there'll be about 20 slides in addition to the recording, 20 slides that Glenn has that gives all sorts of more detailed information. And in a moment, we'll open up as far as, just trying to address some of the questions in the chat. And something, before we get to the questions, something I'd like to just briefly talk about is just general financial security. I did a presentation on this last year, in addition to financial planning. Kendra, I think there may be a slide that Glenn had. If you can open that up, I think it's one of the first slides. Just some general things as far as financial security and things that whether you're planning for retirement or if you're in retirement, different stages of retirement. So Kendra, open up a slide and I'll see if that helps. Yeah, that's great. Thank you. So just a few brief things. One of the key things at the top in the center is debt management, in particular credit cards. And these are things, particularly if you're in a more difficult financial situation. Credit card debt can average between 15 and 20% annual interest, very high interest that you're paying. So one of the first priorities is, if you can, to gradually try to pay down credit card debt. Another area is trying to set up an emergency fund. This can vary by your individual needs, but if you can eventually develop a 3 to 12 month emergency fund that can that has funds for 3 to 12 months of expenses. Another is insurance, and there's various types of insurance. There's home insurance, renter's insurance, disability if you're still working, life insurance perhaps. And another thing that becomes very important is health insurance. One of the things that Doug mentioned earlier is I'm a volunteer for SHINE. It's a state-sponsored organization in Massachusetts, provides volunteer free guidance to anyone on Medicare-related decisions. So if you don't have employer group insurance and you're under 65, what are the different options, whether it's Health Connector by the state of Massachusetts or otherwise, to get individual insurance. And then once you're eligible for Medicare, there's a lot of different options. SHINE is a very good resource to provide unbiased guidance on that. Another important decision is Social Security. People can start taking Social Security in general at age 62, as early as 62, up to age 70. And what are the trade-offs about that? And in July, I think it's July 20th, we'll be having a presentation like this on Social Security. And another item is, it talks about, on the lower left, estates and trusts, estate planning, wills, financial power of attorney, for someone to make financial decisions if you're incapacitated, a health proxy, someone to make medical decisions if you're not able to, and in some cases, trust for different planning purposes. So those are just some of the key things to think about. And hopefully if you engage a financial planner, that they will be motivated to work with you on this. So that's it as far as the interview and just some general items that we're discussing. So we'll open it up to questions now. And I believe there's a number of the chat functions. So I'll either Miriam or Doug, if you want to.
Yeah, we have a question, Steve, about people who, can you refer to people who, to planners who either are Hispanic or speak Spanish or are based in Latin America? Is there a way to find planners who fit that description?
Glenn, do you have any
Somebody
perspective
send
on
me
that?
an
Any
email,
background?
and I'll contact the local FBA in NAPA And I'm sure within their database, they have people that have that specialty. So
Is there a
send
way
me an
for us?
email and I'll try to find you somebody.
Is there a way for us to make a connection to the local FPA chapter or to NAPTA? Can we give a link?
Yeah, it'd probably be specific people. I mean, the Financial Planning Association, you could send an email to the Massachusetts FPA, Financial Planning Association, and ask them that specific question. Yes.
I believe that question came from Chile, actually.
Yes,
Oh,
that's
okay.
right. Hi, everyone. Hello, my pleasure. Thank you so much.
And Glenn, do you want to put your email address in the chat so that?
It's a little dangerous, but I'll do it anyway.
Oh, thank you so much. Please trust me. I'll abide by all data privacy regulations worldwide.
That's okay.
Thank you very much,
I
Glenn.
will take care of it. Glenn, don't worry
Thank
about
you.
it.
We need you here in Chile. We need you all here in Chile and in Latin America. Financial planning, with all the considerations that you've talked about, Glenn, is non-existent from what I understand in Chile or Latin America. And I'm here with a couple of friends in business, potential business partners. And we really much appreciate having the opportunity to discuss eventual business partnerships or advisory services on your part.
Well, we'll try. When
Super.
we were running the financial planning program at Bentley, we had one person from Latin America who got
See?
our master's degree. I don't know where they are today. So I
Okay.
understand
Well,
your dilemma.
thank you so very much for providing us with your email, and we'll be in touch.
Very good.
Thanks,
Thank you,
Antonio.
Glenn.
And
you,
Glenn,
Doug.
there's also a question about, you recommended Vanguard
Yes.
as a more or less unbiased resource. Are there others that you can offer? Maybe one or two others that you consider to be good, trustworthy resources?
Yeah. So again, they all have different motivations. I think Morningstar in general provide they sell information. They're not selling products. I think where you get into trouble is when people are selling products of some sort. So these so Morningstar is probably good, sir. Research affiliates is probably when I look for projections, for example, I like firms like Vanguard, Morningstar, and research affiliates. And in fact, every January, Morningstar sends out this consensus forecast from all the different firms kind of thing. So you can go to January of this year and you'll see the consensus forecast of Morningstar, Vanguard, and research affiliates. And I probably throw out the other couple of product providing big firms that I don't want to name their names at this point. Yeah, TIAA-CREF is pretty independent as well. The only issues I have with Vanguard and TIAA-CREF are, honestly, they're way too much US. Even though they have forecasts that are completely inconsistent, it's very difficult for these large organizations. They will never make they'll do forecasts, but they won't actually tell their advisors or their investors to make shifts. Even if you're a Vanguard, and you made this statement, gee, we should shift out of US into international, it would kind of blow up Vanguard because all their large US and US stock managers would have to deal with all these outflows, and all their international funds would have to deal with all these inflows. It'd be really problematic. So big firms never make calls, but you don't have to be like all the other investors. You don't have to be average. So yeah, I kind of have my dancing shoes on here, Doug, but it's a challenge.
So
Yeah, go on, Doug.
No,
I
go
was just going to briefly say that just my experience, I've read a number of articles by Morningstar, and I found it to be very, very insightful. It is very dense, it's very detailed and technical, but if you're comfortable with that, Morningstar. It's very insightful information on a variety of financial topics.
I always have a story. So back in the mid 90s, I went to this conference in Chicago. The keynote speaker was Don Phillips, and he's the founder of Morningstar. So you learn a lot more in the hallway than anywhere else. So in the hallway, there was a small group of advisors. Nerdy Glenn was part of them. And Don tells this small group of people that, yeah, we cover thousands of funds. There aren't 20 I would invest in myself. So, you know, I'm kind of going a little too far, but this goes back to the ETFs.
That raises a question for me, and that is, I think not everybody understands what an ETF is.
Oh.
Could you give us just a brief primer?
Yeah, so thank you, Doug. And they're exchange traded funds. And basically, they're an index fund that trades like a stock. Index funds, you know, for example, this most simple one is the S&P 500. An index fund will simply buy those 500 stocks in the same weighting that they are, you know, like the first 12% is Microsoft and Apple, which is another issue. But in any case, you know, so an ETF will buy those 500 stocks in those weightings, and they'll buy them for 100 basis points is 1%. So most of your trying to beat the markets kind of mutual funds are charging that or more. You can buy an ETF for less than 0.1%. You know, it depends on the asset class, and there's hundreds and hundreds of these. But buy that book by Goldie, The Investment Answer, or you'll find lots of articles on ETFs. And yeah, it's basically, and it's smarter than buying individual stocks. You buy the individual stocks, you can lose it all. Buy an ETF, it could be pretty volatile. Certainly they have been this year, but the ETFs are capturing an entire asset class, and you reduce that single stock risk because you're buying, in my example, 500 stocks. So yeah, ETFs are a simple thing, and it's kind of a, if you're on the side of Main Street as opposed to Wall Street, like I am, I'm on the side of Main Street, ETFs.
So if you have questions, enter them into the chat. We're a relatively small group, so you could also unmute yourself and ask your question directly. If you have a question, now is the time. And while people are thinking about that, maybe Glenn and Steve, you could talk a minute about a lot of what we've talked about has to do with financial planning, where investments are also a part of the decision-making process. Not everybody has savings that measure up to the level where they need a lot of advice in terms of making investment decisions. What do you recommend for people who may not have accumulated significant assets, but still can benefit by a financial plan?
You need to come up with a to-do list here, priorities, 1, 2, 3, 4, 5. Steve came up with an early one that's perfectly on point. Maybe your best thing to do is reduce your high interest debt. But maybe you probably need an X amount in an emergency fund, as Steve brought up. You know, on the insurance side, you know, there's an old adage, assume the risk you can and insure the ones you can't. So what could, you know, if something happened, you know, your house burned down or whatever, it's problematic. So there's certain levels of insurance you probably need. And again, this is an area where you want to buy it and not be sold it. So do your independent research, but pay down debt, do your cash flow projections. Are there things in your budgets that could change? And I don't want to be unsympathetic. I know there's a lot of lousy, gas prices are up, food prices are up, your rent might be going up. You're gonna sadly have to deal with that. Can you put off consumption? Maybe go back to the happiness per dollar concept. really be reflective of what brings you joy, what doesn't. And I almost can guarantee if you really think that through, you can be happier on less money. Again, it sounds unrealistic, but I often think that's the case.
Well, the point there, Glenn, is that people put themselves in a position to begin to put more money into savings. I think that's where you're going with that.
Yeah.
Oh, absolutely.
And I'll just mention one brief thing, and I know there's a couple more questions and this will be advertised, or communicated through EBN, that in July, we'll be having a presentation on Social Security. In September, a presentation on Medicare, and in November, a presentation on, year-end financial planning, year-end financial giving, and estate planning. So those are some relevant topics to financial security. And I think there's a few more questions, Doug.
Yeah, there's a question about annuities for retirement planning.
Yeah.
Yeah. I don't want to go on a rant here, but
We have several questions, but you can keep it fairly brief, Glenn.
All right. That's hard for me to do. I'll try. So again, this is something you should buy and not be sold. So there are immediate annuities that work for some people. It's a way of ensuring that you won't outlive your money. And in fact, Vanguard used to operate as kind of a liaison. They're not doing it anymore, unfortunately. But you can buy some immediate annuities where basically they sound too good to be true. You're going to get 6% for the rest of your life, kind of thing. In reality, your real return is probably like 1 or 2%, but it does do something for you. It makes sure that you don't outlive your money. So very often there's very high hidden embedded costs in annuities. You have to be very cognizant of. It's kind of a broad statement, but understand who's involved, what the costs are, and a lot of them sound too good to be true. Gee, if the markets do well, you participate. If they don't do well, they'll give you a low rate of return, still guaranteed rate of return. You're up against it. I mean, the actuaries on their side have figured this all out, and I want to get too deep into it, but be cautious with annuities.
Yeah.
So here's a couple of final questions. One is, where do you buy ETFs?
Lowest cost provider is probably Vanguard. You can get very inexpensive ones at Fidelity and Schwab. BlackRock has tons and tons of them. The way
they're widely available.
Very widely available.
Okay. And then how do you know if your advisor is a fiduciary or is playing the role of a fiduciary?
Great question. I think a true fiduciary will put all the conflicts of interest out on the table. I think if you're on a commission basis, that's a kind of a tough one, to be a true fiduciary. I think you start off with the fee only people, but again, even fee only, will they always do everything that's in your best interest as opposed to theirs? I mean, you can go. One of the links we'll give you is kind of SEC, Security Exchange Commission, where you can check out people and see what their history has been. But yeah, that's a great question. It's a tough question, and who's truly a fiduciary and who isn't?
So that's sort of the bottom line, right? Isn't it? It's figuring out who you can trust and if they're working in your own interests. So we have reached the end of our time, and I'm sorry we left a couple of questions on the table, but we do need to close because we want to be respectful of everybody's time. I want to thank both Steve and Glenn for a very informative conversation this morning. This was enormously helpful. As Steve mentioned, we'll have another program along in this same vein on Social Security in July. More information about that will be coming out shortly. I also remind you that we will be following up in a few days' time with a recording of today's program, as well as the slide deck that Glenn has put together and all of the information that Glenn and Steve have accumulated as resources. While you're, that information, by the way, will also be posted on the Encore Boston Network news site, website in a section called resources, and look for financial information. And you'll see recordings and information related to the previous sessions that Steve has conducted for us and that Glenn and Steve have done together as well. I do want to remind you, by the way, while you're at the website, if you are not a member of Encore Boston Network, that's a place you can sign up. It's free and easy. Sign up for our newsletter if you don't get that regularly, and also check out upcoming events. And there are two that I want to call quickly to mind, and that is next week on Wednesday at 10 o'clock, we will be around, 1 o'clock, we'll be hearing from Mick Schmeier, who has created an organization called Growing Greener, and he'll be talking about the climate crisis and ways in which all of us as individuals and working together can move from this sense of anxiety I know that we all have about the climate crisis to doing something that makes a difference. So from anxiety to action. And then the following Wednesday, we'll be tackling the question of food deserts and the challenge that many people in urban communities have in terms of gaining access to fresh, nutritious food. And we'll be featuring the Urban Farming Institute, which acquires small lots and teaches people how to be farmers so that they can grow their own fresh food in those urban communities. And there's lots more like that. So check out our event calendar, and we look forward to seeing you again at one of those events coming up. So thank you again for taking the time to participate. We'll be following up and look forward to seeing you again soon. Have a wonderful afternoon.